In past videos, I've really concentrated on building a personal finance operating system. But anytime that we build something theoretically, when we get into the practical side of it, it starts to break. And the reason that it breaks is not because the system itself is broken, but because we are not analyzing, in most cases, the transaction that's happening correctly. So in this video, I want to talk about income because it's one of the best examples of an accrual that we need to be careful about to be able to record it correctly so that it is represented perfectly or near as perfect as possible in our personal income statement. So most people think their income is simple. I get paid, therefore I've earned it. But that's not actually true. There are two separate timelines happening. When you earn the income is on the first timeline, and when you get paid is on the second. And if you don't separate them, your entire financial system becomes misleading. In the system we've built, the journal records transactions. The journal or the general ledger organizes them by their account balances, and the financial statements summarize them. But all of that depends on one thing. Did we interpret the transaction correctly? Let's look at timeline 1, which covers the period of time from your last pay until month end. You've worked, but you haven't been paid yet. This creates what's called accrued income. And accrued income is something that's owed to you, so that effectively is an asset. So we would debit an accrued income or accrued wages account. You may ask, what's the opposite credit? Well, the credit is, in fact, your income, which is in your income accounts, your wages or salaries, okay? So this accounts for the fact that you have earned or created economic value during the period from your last pay to the month end, even though you haven't received the cash yet. In the case of timeline number 2, this is from the period from month end to the next period or the next pay. You receive a paycheck, but part of it belongs to a previous period. And this creates a scenario where the cash is not going to equal the income. So let's walk through a simple example. Let's assume that you get paid on March the 15th and March the 30th, but March month end is March the 31st. For scenario A, March 31st represents unpaid work. You've worked on March the 31st, but you haven't been paid yet. So we record a debit to accrued income receivable for that 1 day of work, and we credit your employment income. You've recognized income even though no cash has been received. In scenario B, let's say that the period is April 15th where you receive your paycheck. Now you receive cash, but that pay includes the work done on March 31st, which has already been recorded, and the April 1st to 14th period, which has not yet been recorded. So the entry becomes the debit is to cash for the full amount that you've received in your bank account. The debit is to a CPP asset, and if you don't understand that, go back to the other video where I describe it. Another debit is to your EI expense account for the EI component. And you're going to have a credit to your accrued income. So this was the asset from the prior period. Now we're going to credit that. And that combined with the credit for our employment income should equal the total amount that we receive through cash, CPP, and EI. So let's slow this down. That single paycheck did two things. One, it cleared the receivable that represented March 31st's work. And two, it created new income, which was April's work. The paycheck didn't define the income, it just settled and revealed it. So here's the big insight. Your system is perfectly structured. It balances automatically, and it flows into clean financial statements. But it depends on one thing, and that is correct transaction analysis. If you misinterpret the transaction, the system will still work. It will just be perfectly wrong. So I would strongly encourage you to look at your most recent pay and go through the exercise of setting up the timeline where you have your pay period timeline, and then set up another timeline that goes from the end of the month to the beginning of the next period where the next paycheck is, and splice out before the end of the month where you have those accrued wages, and the same amount that is for that accrued wages is your salary or income. Then after that month end, you're going to have your paycheck, and that paycheck is going to represent the sum of the actual amount that you get paid, the CPP asset, the EI, potentially taxes as well, that I've dealt with in another video. And that should be balanced by the credit to your accrued wages and the credit to your salary or wages that you've actually earned during that period of time. So here's the big takeaway. Most people track cash, they build budgets, and they guess their performance. But now you're doing something different. You're separating the economic activity, what you earned, the economic value that you've created, and the cash movement when you were actually paid. If you understand this, you've crossed a major threshold. You're no longer tracking money, you're modeling it.